Hi, Natalie.
Hi, Safia, how are you?
I'm good. Welcome to Ideology Podcast.
Thanks for having me.
So I'm super excited about this interview because I feel like I know next to nothing about money.
Yeah.
And I'm imagining there are other people out there who are like me. I feel a bit out of sorts because I am constantly told I'm at the age where I should know more. I'm in my late 40s, and I'll have to say I know next to nothing about money, but even less about building wealth.
Okay.
And I think you're the perfect person. So would you introduce yourself to our audience and tell them why you are the perfect person to help us understand money and building wealth?
Okay, perfect. So yeah, firstly, I'm Natalie. I am a financial advisor for a FTSE 100 company. I love what I do because, as you said, Safia, you feel like you should be doing more, you feel like you should know more. And I think nearly everyone else is in the same boat as you there. Like, we read things and we see things online and we think, oh, we should be doing that, but we don't always understand it. And I always say to people, you don't know what you don't know. So the first kind of step is understanding what stuff means and how it affects you in your life, because again, everyone's very different. And just by understanding financial jargon, terms, and all of that can take that level of confusion out of it. And sometimes I do think things are made to be overcomplicated, so people don't really know what they should be doing.
Mm-hmm.
Whereas if you just have someone who sort of makes it understandable and explains down into layman's terms what everything means and how that relates to you and your setup in your life, it gives you a lot more clarity into, right, this is what I should be doing, this is what I should be thinking about. And why I'm a great person to talk to about that is, yeah, I've been doing it a long time.
Mm-hmm.
And as I said, it's about being able to, not only for me, I need to understand financial jargon, but I need to be able to make it easy and understandable to people I talk to. So by me understanding it, and I can explain it to you in your words, in your setup, and what that means for your life and day-to-day earning and spending your money, it becomes a lot more real for people when I speak to them, and they can actually apply it, like I say, to their lives and what they want to in their future.
I really love that because I watch CNBC a lot. I watch all these money channels, and I actually think they deliberately overcomplicate stuff. So why don't we start with understanding, first of all, mortgages?
Yeah, it's a hot topic at the moment.
Right. Almost everyone I know thinks home ownership is really the path to a happy retirement.
Yeah.
Would you say the best way to save and invest is in home ownership?
I can see why lots of people think that way. Us, especially in the UK, we have a bit of an obsession when it comes to property, and I don't blame people for being obsessed with it, because if we look historically, a lot of money has been made in property. There was lots of different areas that you could make money in property, and just from, as you say, something simple to owning your own house, living in it throughout a period of your life, and then you move on and you can take that extra equity out of the house. And that was the case for a long time. So it's almost ingrained into us, and what parents and grandparents or family friends down a pub say to you is that property is the way to go. And again, it's a very safe investment in the sense of you own an asset, you live in it, and there's only so much that asset value can deviate. One thing I think people do need to be more aware of in the times we're living in now is the growth in property value that we'd seen previously isn't around as much as anymore. And a good example I use is, I came across some individuals who had bought up some ex-council properties about 20 odd years ago when the government were doing the right to buy schemes. They were buying 3-bedroom houses in South London for £45,000. They sit in there, they live in it for 10, 15 years, and they are selling it off for 450,000, 500,000. that can't be done as easily anymore. Firstly, the property prices are high and we're not seeing them grow as quickly, like I said, in that kind of time frame. But a big driving factor to that is salary and wages aren't increasing in line with the way property values were growing. So we're constantly finding ourselves almost on a back foot in trying to keep up the purchasing power when our income isn't growing in line with that. So we can't afford to be acquiring properties as we used to, because you don't come across those kind of bargains, so to speak, anymore. We're very over concentrated, and so it gives you a sense of freedom and flexibility in having some ownership, and you've got something there behind you. If you do need to release some equity, you've got a house to sell to do that. But I wouldn't say necessarily that that's always the best investment for every single person out there would be to buy a house.
So it doesn't really lead to the financial freedom that we've been led to believe. So if you're buying a house today and it's $500,000, for you to be able to actually retire off of that, you'd have to sell it at a price that's just not there. And there are other things associated with home ownership that make it more of a liability than an asset. Can you talk to us a little bit about that?
Yeah, again, for example, we're seeing it very much so now. So people, when you go to buy a house, as we know, you put a portion of your own savings and money down, and that's your deposit. And then the difference between the value and what you put down as a deposit, you go and get a mortgage out on, and that's effectively a loan. And you will be paying that back with interest at different rates. Obviously, interest rates are very high at the moment, so it's costing people a lot more to borrow. What we're finding now, though, is, say 5-10 years ago, you would have taken out a mortgage on a house, and just say, for example, it's £200,000 on a mortgage you've got, and you were paying 1.5% in interest. That can be very affordable for you then and there at that time. As what we're seeing now, and we've all heard in the news, interest rates are going up, inflation's going up. If suddenly your interest changes from 1.5% to 5%, those monthly payments that you were making for the house that you live in, that's the same value as it was, maybe a little bit higher, you're suddenly, rather than paying £500 a month, you could be paying £1,500, £2,000 a month. The affordability side of it, hardly anyone can sort of swallow and afford those increases when you're not increasing your income as much anymore. And another thing I think that we don't really look into too much when it comes to property, especially in the UK, is you hear it all the time. You might hear someone say, oh, I bought this house for 200,000, I've now sold it however many years later for 400,000, I've made 200 grand profit on this. But if we actually think about it, have you really? Because firstly, depending on if you lived in the house or not, you might be renting it out or whatever, there'll be a certain amount of taxes to pay on that gain. So you have capital gains tax. If you lived in the house, you don't have to pay stamp duty taxes. But if you didn't, and you were sort of renting this out and it's an investment property, you will have to pay stamp duty on that as well. And that again varies depending on how many properties you own. So a big chunk of that supposed gain is gone to taxes. And then secondly as well, yes, you might have bought the property at 200,000 and that was the value, but did you really pay 200,000? And that's the thing I think people don't actually look into too much. Your mortgage might have been for 150, and over 25 years or 15 years you've been paying back to the mortgage company with the interest. If you added up all of those mortgage payments you've paid over a 15-20 year time horizon, that could be 350,000 you've paid the mortgage company for a house that was valued 200,000. And when you come to sell it at 400, you think you've made this huge gain, but really you've
made
paid
50,000,
and then you've probably got to pay that in tax anyway. So you're just about breaking even, but we don't see it like that because we just look at what I bought it for and what I sold it for. We don't actually look into what money I've paid into this over 15 or 20 years.
But why would that be the case? You'd imagine that people actually are told exactly the amount that they're going to be paying at the end. Is that not their case?
They are told, but again, what I think most people think about is it's one of those almost kicking a can down the road kind of thing. Like, we're so eager to get the property. It might be your first property or your first rental property or whatever it is. We're just glad to have got that mortgage. And okay, what's that monthly mortgage amount? It's £1,000 a month. Cool, I can afford it. We don't actually look and go, well, how many £1,000 a month over a 24-year term of a mortgage? Well, that's a lot more than what the value of the property is worth. But again, we're just very property focused here in the UK.
But is it because also people think, you know what, I might as well pay £1,000 mortgage instead of paying 1,500 in rent with nothing to show for it?
Definitely, because again, it comes back to that ownership bit. I feel like this is mine, and I fully understand it.
And the security, is it, you feel more secure, right?
Yeah, a landlord can't just change his mind and kick you out and, oh, I want to sell this. Which now.
You've got so much.
Yeah, definitely.
So many landlords are being forced to sell. Can you talk to us a little bit about negative equity?
Yeah. So when it comes to negative equity, what we're finding again is sort of, as I said, leading on from what I said just then, people are purchasing a property maybe at a time when property that prices were doing quite well. They get themselves into a mortgage. A lot of times, especially in London, people are very highly sort of leveraged when it comes to properties, in the sense of they are getting the absolute maximum that they can afford, or the banks are willing to lend them. They want to get as much as they can with the least amount of down payment themselves. And I get that.
Yeah.
But all it takes is a blip in property prices, as we're starting to see now with high inflation and high interest rates. People aren't buying as many properties because the affordability is less. What that then causes is what we need to get demand back up for people to keep buying houses. So what do? Let's drop the prices a bit. But if you maxed out the mortgage and maxed out this borrowing, so to speak, on a property, all it takes is for that value to go below what you're borrowing, and you're suddenly in negative equity. You're paying for this property and you're paying more than what it's currently valued at.
Yeah.
So
there's I don't know what the stats are, but there's a lot of people who are finding themselves in that because of the drop in property prices. So let's say you're someone now that is in debt.
Yes.
And it might be because of property. It might be because you're a crazy consumer. Like I've been at different times in my life, you know, with credit cards. There's different reasons we get into debt.
Yeah.
What would you say to someone who comes to you and wants to get out of debt and start to actually build up some savings?
Yeah, of course. So I fully appreciate that when you're in debt, you might have a credit card, you might have taken out a loan, or you've got a car and hire purchase. There's a few things going on. It can be very easy to like get bogged down, and you almost can't see a way out. And you're almost in a vicious cycle of pay off one credit card by using up another credit card, and so to speak.
Yeah.
And it can be very overwhelming. And again, I see people sort of trying to keep 100 plates spinning at once, and they're trying to pay everything down all at the same time. They just feel like they're getting nowhere. And that can really ring true, because it does happen. Kind of general rule of thumb I like to say to people is, if that is the case, you're finding that, like, you know, you're just paying the minimum off your bank cards every month and it's not getting anywhere. Take away the noise. And what I say to people is, look at the interest rate that you're being charged on every single debt and loan you have, whether that's car finance, whether it's credit cards, whether it's, like I said, hire purchase on cars or personal loan you've taken out. And write them all down and write the interest rates that go with each debt. I always then say to people, focus on the debt with the highest interest rate, because that's the one that's growing the quickest. There are, again, I speak to lots of people, they might have a loan, but then this credit card's at 0% interest. So let's pause the 0% interest one, because we know that that's not getting any worse for now. It might be 0% interest at the end of the year, so to speak. And let's put all of our attention into the other credit card that has got a 5% interest. And let's focus on paying that down. So like I said, the kind of general rule of thumb I say to people is, focus on the highest interest rated loans and debts you have, and work your way down that way. And again, it is just sometimes sitting down with yourself and putting in a 6-month plan, a 12-month plan. I say to people, you know, if you've got a few things going on, right, if we can put £150 a month to paying off this credit card, and we'll pause and ignore this one for now. It might take 12 months to pay that off, and you pay it off. Then we redirect those funds to the next lowest, or the next highest, interest rate. And then we'll focus on paying that down. And it's one of those, don't beat yourself up about it. Try and do more than the minimum. But again, when you've got a few debts going on, it can be hard to spread yourself so thin across everything and be doing more than the minimum on everything. So that's why I say, if you're going to do that, focus on the highest rated interest rate and then work your way down and stick to it. You do have to be a bit self-disciplined in the sense of setting up direct debits to credit cards that isn't just the minimum, and pay down actually the capital on the debt rather than just focusing on the interest. Because if you just pay the interest off every month, that actual underlying debt or loan isn't going anywhere. It's not reducing itself.
And obviously the looming biggest debt we all have is our mortgages. Do you think most people have a type of mortgage where they had a low interest rate for several years, but then once that time runs out, they now find themselves at the new set interest rate by the Bank of England?
Yeah, that's exactly it. So following the financial crisis in sort of 08, 09, we had a big property crash, run on the banks, everything. It was a dire state we were in. So the Bank of England and the government sit down and say, how can we get activity and movements going again? How can we get people buying and acquiring assets and parting with their money? Because people had very low confidence in sort of the banking systems and the financial systems. And the way they did that was drop interest rates way, way down to sort of close to 0%. And it was an experiment and it worked very well. People then can suddenly afford to borrow more and do with those and get on the property ladder, sort of start doing those things they've been dreaming about for years. So we jump into these mortgages at very low rates, and we were very blessed in the sense of it was just meant to be an experiment, but it worked so well. The government kept it down for a long time. So we had about 12, 15 years of sub 2% interest rates, which is almost unheard of before the financial crisis. And where we had it for so long, I think naively everyone just assumed it would stay close to that. You know, if it went up to 2.5, that's okay. That's sort of the usual normal. But no one could sort of foresee what was happening down the road. And as you said,
and most people take a couple of decades at least on their mortgage, right?
Definitely.
So it almost feels, misleading, because if you tell me, what do you think that people who manage to get those low interest rates for the lifetime of the mortgage, or nobody will get that deal?
Very rarely. I was going to say I've come across the odd individual who had locked in a dream interest rate of like 1% for 10 years on their mortgage.
But again, it's only 10 years. And what's the lifetime?
About 25.
So
they're hitting now when they're re-broking their mortgage now. The interest rates run out and they're going from 1% to 5%, which in real money terms means that monthly mortgage payment has not doubled, not tripled, it's gone up 5 times in the space of 30 days. And they've been used to 10 years of a set amount.
Wow. So for someone like that, the advice you would have hoped that they would have paid it down, or at least tried as much as possible to outright buy the house when the interest rates were low.
Definitely.
And if they didn't do that and they thought, oh, flush with cash, then they have
definitely. And you can't blame them. I see it. I did it myself. I bought a property and I locked in on a great interest rate, 1.5%. Naively, you think it will carry on. So I only locked that rate in for 5 years. In about a year or two.
But is that because that's all that was available?
They did a 10-year period, but it wasn't quite as good interest rate as the 5-year. So I thought, well, I'll just lock in for 5. And then when that 5-year runs out, I'll lock in for another good interest rate.
So it would have been higher for the 10 years?
Yeah, slightly. Again, so for 5 years it was 1.59%. For 10 years it was 1.89%. Because again, how you've got to think of it is the mortgage property or the mortgage lender is promising you a rate that they have no idea if it will stick to or not.
But they have to stick to it.
They have 10 years. Yeah,
right?
They have to, but they don't know what in the next 10 years the Bank of England's going to do in terms of setting their interest rates.
And in that case, if, for example, like now the Bank of England has raised it to 5%,
Yeah,
and there are people who still have another 5 years
yeah.
at 1.89%, what does that mean for the actual lender?
It means that for them, it's costing them more to honour that rate.
Mhm.
And that's why they don't like it. So that's why they put it slightly up. But even then, they didn't foresee this happening either. So it's all a kind of
Isn't that
reactionary.
always the cycle though?
It's always a cycle. And this is one of my favourite sayings is hindsight's a lovely thing.
Mm.
And you come across it all the time when it comes to finances, mortgage rates, performance. If you're looking at the performance of a certain stock or fund or asset, well, it's very easy for us to look at it today and look back the last 10, 12 years and say, well, if I did that then, and if I did that then, I would have doubled my money. But no one has that viewpoint then and there in the present. It's all a kind of finger to the wind and what we think could happen around the corner.
Right.
And it becomes a lot easier to turn and look back at the path we've just travelled and say, oh, well, I shouldn't have made that turning or I shouldn't have made that decision. But at the time, no one can give you that information. So you can't blame people for jumping into a mortgage that maybe now they can't afford, but a few years ago they could very easily afford. No one foreseen what we've seen in the last, say, 2 years happening. Even we knew interest rates couldn't stay as low as they could. We knew that inflation was going to go up a bit with sort of Brexit and lockdown. No one, anyone, even the experts, if you look back at that experts or CNBC, all of those money shows that you say you watch, no one was like, guys, next year inflation is going to be 10, 11% off the records.
No.
So you're constantly sort of battling new storms and weathers that you didn't know were coming when you thought it was going to be plain sailing. But it's then building and planning to give yourself that kind of, I call it like financial resilience, in the sense of if something does happen, if there is an unforeseen change, you need buffers put in place to not set you completely off track when that happens.
That's really good advice. So what would you say to, let's say, a young married couple? They have to have a house.
Yeah.
And their options are we rent or we get a mortgage.
Yeah.
They have no they have no choice but to get that 6% right now that's being offered. What would you say to someone like that?
I would say to someone like that, you know, again, if it's someone who they could maybe delay that purchasing a property for a year or so, I would be tempted to delay it just to see what happens. Because again, right now we're in a high reactionary environment. Everything's done. We see something happen and then the banks put up the interest rates and we see that and it's all reactionary. So if you don't need to jump into that hot boiling pot right now and accept that 6% interest rate, maybe just let the sort of storm settle a bit.
Right.
And let things calm down a bit. And like I said, not be jumping into something so in the deep end. Again, I do come across people who they need to buy property now. The landlords are evicting them, or you know, they need the extra space and they have to jump into that hot pot, so to speak. Then do it, of course, because you get the ownership, you have that sort of security in this is my house.
Can they get a deal where it's 6% for a few years, but then they can refinance? Yeah,
definitely. So again, normally when it comes to mortgage lenders, they'll let you do either you can fix an interest rate for 1, 3, 5 or 10 years.
And if it goes down, if the interest rate goes down, you're allowed to go down?
You don't follow it down. So again, that's something called a tracker mortgage, where you just track the interest rates. And again, if you know that interest rates are going to be dropping, that could be a good thing to be in, because then every month that the interest rates drop, your payments drop in line with it.
So unless you have the specific type of interest rate deal, the tracker mortgage, then you're
locked in at whatever rate you locked in for the period of time you locked in. But again, it's a kind of flip of the coin, because if you're in one of those tracker mortgages and you think, oh, interest rates are going to stay low or get lower, and suddenly, like we see, they jump up, your mortgage will be jumping up with that too. You literally track interest rates for good and bad. Whereas someone who might have locked in an interest rate for 3 years at 1.5%, right now they're rubbing their hands together because they know they're stuck at 1.5% or whatever it is for 3 years, rather than following up to 3, 4, 5, 6% or whatever. So again, I think everyone wants the reward without the risk.
Yeah.
But it's one of those things.
Is there none? Are there, first of all, then the types of mortgages there are? What are the different types?
Okay, yeah, so there are different types in the sense of just pure out property ownership. I'm not going to go too much into like shared ownership and help to buy schemes, but in regular property mortgages, you can get interest only mortgages, which, as I was sort of when we're talking about the debt, if you pick an interest only mortgage, you are every month just paying the interest that has been gained on that mortgage. For example, we take out a 200 grand mortgage and it's an interest only mortgage. Whatever that interest rate that we've locked in at or that we're tracking, that's what we pay every month. But that 200,000 that we borrowed will never get paid down.
Oh,
whereas you can also get repayment mortgages, which the monthly amount that you'll be paying will be a lot higher, and you are paying some interest, but also in that monthly payment, so you're paying £1,000 a month to the mortgage, a good chunk of that, if not most of it, will be used to pay down the actual debt that you've borrowed. So you will see the kind of, we call it an outstanding amount on your mortgage. Every year that outstanding amount will go down and down and down because you're actually paying off a chunk of what you've borrowed.
right.
You also can then pick a part and part mortgage, which is part capital repayment, part interest only.
Mm-hmm.
And again, that's kind of for the affordability side of it. If you go pure repayment, they can be very, very expensive mortgages. So with the part and part, you're almost paying down an element of the capital or the borrowed amount, but also half of that will just be interest that you're paying.
So how do you decide which one's right for you?
A lot of the time it comes down to, firstly, affordability, and secondly, what you're planning on doing with the property. So, for example, if it's a house that you live in and you plan on living it for the rest of your days, and you know, once you pass away or something, the plan is to pass that down to your children, something like that, you'll probably or may want a repayment mortgage. Because once you get to a certain age, and say you're 50 or 60, you've cleared the mortgage, you suddenly are living in a house that 100% is owned by you. You don't owe anyone any money for the property. And when it comes to passing that down, your children are inheriting a whole house and no debt is following the asset down to the children.
I like that.
Whereas if maybe you were sort of purchasing a flat or an investment property that the plan is to rent it out, make a bit of residual income, wait or hope for the property prices to go up in value and then sort of sell it off to give yourself a cash injection to go and do something else. Or maybe something like that is interest only mortgage. Because again, depending on what you're renting it out for and things like that, you might want a bit more money in your pocket every month rather than paying off this big debt. Because you know anyway the plan is to release that property 10, 15 years down the line anyway. You'll sell it
when the prices go up. Yeah. So first of all, find out. The most important thing is to know what you need the property for. Is it an asset that you want to pass down to your children and live in, or is it an investment for you to make a little bit of side money? Are there any other things that people generally would buy a house for?
Mainly those things, I would say. The only other, so you've got the investment properties.
Unless you're a Qatari and you're like, oh, you know what, I need a holiday property
just
in every city.
And yeah, even with that, like if you've got holiday homes and stuff, it may be, again, it comes down to, is it just sat empty when you're not there? If that's the case, then
for those people, yes. Yes, empty, waiting for me.
I don't know, if you're in that kind of situation, then maybe you're not too much worried about paying off a mortgage or anything like that.
Building wealth. You're one of right. Don't watch this channel.
You're already at the finish line. You don't need the lessons.
Yeah. Okay, those are the two types. So what do you think? How do most people, when do they get in trouble? Would you say it's when you've lost your job, when you've lost your side means of making extra money, that's really when you've hit crisis point, and then the interest rates have gone up.
Yeah, that's it. I would say, kind of going back to that financial resilience bit again, if you're at a point, or lots of people are at a point, say 2017, 2018, they've got the house, they've got the mortgage, and getting by, great.
Yes.
And then one change in interest rates can suddenly put you out of whack. You suddenly, the income you're on, you can't afford what you were borrowing before. Or as you said, you lose your job, and because every single month you're kind of living, not quite paycheck to paycheck, but you were getting by, not so much savings or putting things to the side or having a nest egg on the side. You can't blame people for that either. I understand we're sort of all living for today. We don't know how much longer we have on the earth, so we don't want to be stifling everything away and living on beans on toast for the future, and sort of living in that scared lifestyle. But at the same time, if you do lose your job, if you lose, if it's a rental property and the tenants move out and it's hard for you to then find someone to replace it, all of a sudden you've got a big liability on your shoulders there that needs paying. And again, it does come down to, I fully understand why people want to own their own properties, because it's like, it's my house, but a couple of missed mortgage payments and it's not your house anymore. They're taking it off of you.
How patient are the banks?
Again, it's can depend who you pick up the phone to on the day and what mood they're in. They usually, and again, more recently with COVID, with Brexit, with the furlough schemes and people sort of losing their jobs and all of that stuff, they were being a lot more patient. But you can't.
They run out of patience.
They're starting to run out of patience as well, because again, if everyone's coming into struggles and everyone's hitting on bad times, there's only so patient they can be if 80% of their clients or borrowers are all in the same boat. Well, it's either we let you off the hook and we're in hot water, or we put you in hot water and get ourselves out of it.
Yeah, because they also have shareholders, right?
Yeah.
And they need to be
paying to do all of that stuff.
Yeah. So you're saying the most important thing is to always think ahead.
Yeah.
Have a conversation with someone like yourself to build financial resilience.
Yeah.
If you've just got a really great job, it pays well, you've just gotten your mortgage approved, you're getting that house, don't think this is your time to party and just Ibiza, Dubai,
all of those things.
All those things. Start to think a little bit ahead and think, okay, 10 years down the line, I might need a bigger chunk of disposable income.
Yeah.
A lot of times it's divorce too that now has come into play, and then lawyer fees, trying to figure out who gets to keep the house. So then you have, not only are you dealing with financial upheaval, but you're lacking the mental clarity to even make the right choice for yourself.
Yeah.
What would you say to someone in that kind of situation?
I would definitely say to someone, at least have a conversation with someone like myself, an advisor, because again, as you just said, you've got so much going on and you're suddenly dealing with lawyers, or, the kids going from different houses, routines have changed, and you're suddenly gone from a dual income household to a single income household. And that alone doubles the pressures and stresses of just covering the outgoings. So to have someone you can go to who again can look at everything that you've got coming in, all of your financial responsibilities that are going out, and just help clear the noise and silence it a bit to say, right, this is what we need to be doing to make sure the bills are still getting paid, or putting something aside so you can build up a deposit to go get your own house that's more affordable for you, can help you with, and there's lots of things, again, women particularly aren't aware of when it comes to divorce. So a good one we come across a lot of the time is, it's called pension sharing orders. So when a couple gets divorced, as you sort of know, you'll split up the house or the assets and things like that. But the things that you both have, so pensions, you're entitled as his wife to half of that pension.
I did not know that.
Yeah. And again, so that again can just be give you a bit of a breather, but we're, again, especially as women, we're always trying to spin so many plates in looking after ourselves, not just to get through to the end of the week, but then we're thinking about Christmases, birthdays, and then you've got to go on holiday next year, and then I need to find a place to buy a house now. I've recently separated, and then you're also trying to think, well, what about my pension and my retirement and later down the line? That's one thing less that you don't have to think about, because you can get a portion of pension sharing order, for example. It can just sometimes clear the noise. And people, again, I always go back to this you can't be expected to know what you don't know.
Right.
And you just need to go to someone to say, actually, this is what you're entitled to. This is what you're allowed to ask for and request. And these are things that maybe suddenly now you've gone from 2 incomes to 1 income. Are there other benefits or allowances that you can be claiming that you didn't know because with your previous setup, you probably weren't entitled to?